Okay, welcome back to the show. Today's episode, we have Mr. Aaron Bennett. Aaron Bennett, good day, sir.
How are you? Great to meet you.
Very well. And remember, I'm going to do my best not to cough on you, so bear with me.
Yours mine.
Just for some context, I met Aaron at a high-level, we'll call it a mastermind out in Vegas. I was there meeting investors and decided to stop in on this mastermind. Aaron was there. We actually sat next to each other. And what he does is so interesting that my audience would really, I think there's some wonderful synergy in terms of whom our audience appeals to here at the channel and what it is you do, which is really interestingly cerebral and oftentimes kind of gate kept for the wealthy and ultra wealthy. Am I correct on that?
Yes.
Okay, so I would love to kind of start off. How did you get into this? Because you are not a CPA, correct?
No, I'm not a CPA.
You've got this interesting umbrella of wealth preservation, wealth creation, CFO type of things. Why don't you give us the elevator on it, and then we'll go in.
So about 15 years ago, I got 3 blood clots, pneumonia, about died. So I was in business development. I was in Australia. I was helping companies grow. I was doing sales, purchasing, doing a lot of different things. And so I started traveling the world. And while I was traveling, I was like, hey, what am I going to do here? And I'd been traveling 3 years at that point, and I decided to come back into accounting. And so I did that while I was traveling for a little bit longer. I rushed my degree. I did a 4-year degree in 3 years to get it off the ground and moving very quickly. And I met my wife while traveling, came over to America. I'm Australian originally. And I had lost a job at a 401k company that was doing compliance and tax returns. And I went to my wife, hat in hand, to start a business. And I thought, I've done bookkeeping. I've worked with over 600 companies on the bookkeeping front. I then went into like the 401k area, and I was like, I can't work for people in corporate America. I just don't like it. It's not for me. So I started a bookkeeping company. But while I was doing the bookkeeping, a client of mine who was working with a CPA firm got a surprise tax bill for, it was only about $18,000, but it impacted her home life. And I was like, well, that's a problem. So I went out and I incorporated tax preparation into what we were doing. I brought a person on, created a strategic partnership with someone to do the tax prep. But I realized very quickly that it wasn't saving anyone any money. And I'm like, but there's got to be a way to provide value. So I went and joined masterminds, started working with some of the top tax experts in the country to add tax planning on top of that. The problem is that with tax planning, it requires capital. And a lot of these smaller business owners, they don't necessarily have the capital to be able to invest in strategies. CFO services was then the next thing that I had to add on so that I could grow a company, save them money on taxes, reinvest in the company, and then move the company forward. And so the next thing after that was, okay, well, what do I do now? Like, I'm getting these companies to grow. And then I started getting asked, like, Aaron, can you help me exit? Just so happens the tax planning helps fuel future growth, because if I can go put money into a tax planning strategy where I'm not putting $1 in and getting a 30 cents in the dollar deduction, like just putting money into like oil and gas or those types of things, if I can actually leverage that dollar and get a $4, $5, $6, $8, $10 deduction, I can grow these companies aggressively. And then we eventually get to a place where the company has grown so aggressively that someone will offer us money for it. And then we save money on the back end with the taxes, because sell a company for $50 million, you're going to have a fairly good tax bill. If we can then leverage it, we can then turn around and we can take that and do even better. But then we can also take money off the table in real time if the client doesn't want to grow aggressively. It's like, we saved $200,000 cash from the tax man. Take that off, go put it in investments. Now we can increase net worth so that the biggest asset that we have that can quickly turn into a liability as a business owner is now we're kind of hedging against that by putting money into the market, real estate, whatever it may be.
Okay, so fascinating. And so you focus on, I want to make it clear for everyone, that you focus on growing the wealth through minimizing tax payments, basically.
Yep.
And these are strategies that typically were reserved for the ultra wealthy. I don't know, 70,000 pages of tax code, I guess. Do you consider yourself an expert in the tax code?
I see myself as a general practitioner, okay? My job is, and what I'm very good at is, one, growing companies, finding the bottlenecks in the business, but two, finding people that have really good strategies with very, very good track records. So 70,000 pages of the tax code. I can't know them all, but I can find the people that know how to leverage the tax code, the surgeons, that we can then bring in to do specialized surgery. So I know 400 plus strategies. I can go out and I can bring an owner in and I can be like, all right, tell me about your financial life. What do you want to achieve? Where do you want to go? And I'm not a wealth manager, but what I can then do is go, okay, based on your risk profile, this is what we should do for your strategy. And I can do all the calculations because being a CFO, I'm very, very good within Excel spreadsheets. I can then put together a calculation and go, okay, this is how much cash we will save. If you put $140,000 into this structure, you're going to reduce your tax liability by $300,000. We're going to have that delta of $160,000 left on the table. Go give it to your wealth manager, or go and take it and put it into oil and gas and other investments, real estate, whatever kind of tickles you fancy, and we can take it off the table at that point. But I bring in the specialists because they've got to have an opinion letter, they've got to have audit protection, they may need accounting, they've got to have a track record of success against the IRS, because I find strategies every day, new ones coming across my desk, 100 plus a year, but they've never been challenged by the IRS. So if you haven't been challenged...
Strategies, let me interrupt for a second. So these strategies that you implement for your clients, are they preemptive, or is the IRS already come knocking on that CEO's door?
So it is beforehand. So we're doing the planning through the year. So we do the planning through the year. We don't want to get them when they've had the IRS come knocking. We can do the audit defense, but that isn't where we specialize. That's normally for our clients that are already with us. Then we come in and do the strategy. So it's planning throughout the year and then investing in whatever the strategy is by the end of the year to conserve cash flow.
Right. That makes sense. It's interesting, your journey. You really started kind of at the foundational level, which is the bookkeeping. And then you kept ratcheting up your clientele and then saying, okay, well, in order to meet the needs of this new client, they're going to need ancillary bolt-on services as well. That's very clever because there are different needs at different stages of a company's growth, correct?
Yes. If you're at the 200 to 500,000 range, the amount of tax strategies that you have is like this. If you're 100 and below, you got a ton of strategies that you can use. If you're above 500,000 net income, this is all net income, 500 and above, the world opens up for you at that point, and you have a lot of things at your fingertips to be able to do. And so it's basically most people sit between that 200 to 500 range, and that's where the IRS and the government doesn't incentivize people as much, because you've got to invest in one of four things. It's charity, it's energy, it's housing, or business. Those are the four incentivization tools that the government kind of puts in front of everyone the same, and then it's telling you basically go invest in one of these so that we don't have to.
And when you, for instance, you're talking about energy, and I have a lot of energy clients in my side of the business as well. Specifically, you're talking about carbon credits?
No, not necessarily. It could be that we're going to do solar. Solar is a great one. It's sort of coming up the table now, but that was one that was very hot for a while. Oil and gas is another one that you can invest in. There's all types of different things within the energy realm. Those are the most notable that you can invest in to invest in energy so that the government doesn't have to do it itself.
And let's stay on that energy path. So a client needs to shelter some money.
Yep.
And they speak with you and they say, I really like the energy space. Is this a government sponsored bond or fund or something? What is this?
This is just a fund. So we use one that has been around 40 plus years. I know if from their prospectus or their PPM that if you put $100,000 into it, you'll make $140,000 median rate of return over a 10-year period. However, in that first year, you're going to get $92,000 worth of depreciation. Now, it is you put $1 in and you only get 30 cents of deduction, but that may be something that a client wants. But what you should do first is, same with that, my $140,000 to reduce your AGI by $800,000. Well, you've got $160,000 worth of cash left over. You were going to pay $300,000. You've only put 140 in, you got 160 grand left over. Go put that 160 into oil and gas. Next year, you're going to basically have, let's use $100,000 for ease of use, you're going to have $92,000 worth of depreciation. So you already start the year in a negative, and that money is going to make you 140% over the course of 10 years, and you're going to get mailbox money for the next 10.
And that's including depreciation.
So the 92,000 doesn't include it. That's just, you put 100,000 in, you'll make $140,000 $200,000 over the next 10 years. The 92, I'm not including in that calculation at all. That's just what you're going to get as a reduction for the following year, same year or following year for depreciation.
So these are PE funds basically that
yeah,
they're sourcing, or who sources these for the client?
So a lot of different accounting firms are part of it, but normally you want to have relationships with wealth managers, you want to have relationships with estate planners, you want to have relationships with all types of different people to be able to get access to those types of structures. Because again, it's got to be the right strategy for the right person. And so making sure that it is the right strategy is part of my job, and then putting them in front of the people that do the structures is really, really important, because you've got to be part of different groups, you've got to be part of different organizations, you've got to make sure that it's gone through an audit and won more than once, otherwise it gets highly risky. And that's not what we're here for. We're not flying by the seat of our pants. It's got to have a track record of success.
I like that. And so give me an idea of who your ideal client typically is. When you get a new client that comes and knocks on your door, how do you assess them for how you can move the needle in their business?
They've got to have marketing already dialed in. I can do a lot of things. I'm not a marketer. If they've already got marketing dialed in, I can take that company and I can grow it very, very aggressively. I've taken companies from $300,000 a year to $35 million in 3 years, and they've paid minimal amounts of taxes. We chose to pay some taxes. So they paid maybe 5% over the course of time, and they sit at about 30% profitability. So they really want to be these companies that have got marketing dialed in, or a highly profitable company is the next best thing. So if they're a $2 million company, they're at 30% profitability, we can probably do something on the tax planning front, but then we take that cash, we reinvest it, they find a marketing person that's going to be able to scale the marketing, and then we just continue to cycle that wheel again and again and again to ratchet the company up to these larger levels. We install a C-suite and get them ready for an exit, or the same thing that gets you to an exit is the same thing that can make it so the company will just throw off cash and you only have to work 10 hours a week.
Very interesting model. So that's part of the CEO hat you wear, CFO hat, excuse me.
Yeah.
That's interesting. So let me get back to the question about ideal client for you. Like, where are they at in their business, and are they problem aware, or are they solution aware with your services? How can you take me down that journey?
It really depends, and that's a typical accountant answer. It really depends. Sometimes clients come to me and they're at negative $300,000. And they're like, what do I do? And then we've got to rehab the whole organization and then do the tax planning. So there's always a problem behind those types of companies. Other companies, it's like, I'm looking for someone, I'm highly profitable, I want to grow, I want to exit, I want to do those types of things. So they already know that they need a CFO, so they're looking for a solution for that. So it really depends what the problem is in the company. Like, I know what to do, I need someone to track all my metrics so that we can grow. The other one is like, I'm struggling with profitability, I need help, I need to rehab this company. We do either.
And so profitability at Bennett Financials, that's specifically looking at a major chunk, I should say, is looking at the implemented tax strategies that they're currently using, what they can leverage more of to increase cash flow, to reinvest, to bring up bottom line numbers.
It can be that, but if you're at negative, there's no taxes. So at that point, it's really like looking under the hood and looking at the key performance indicators, pointing to the bottleneck in the business and like going through it all and being like, all right, we can reduce this, and doing like zero-based budgeting and making every single line item justify itself, and then bringing that profitability up so that we can actually take advantage of the tax code. But that takes time. That's why it's always a company that's worked through the marketing, because it might be that, again, lifetime value to customer acquisition cost is the problem, or it might be that their customer acquisition cost payback period is too long. There's a lot of different KPIs that we can look up under the hood to bring profitability back really quickly, and then we turn on the tax planning spigot, we get the cash, and then we work out where the bottlenecks and the constraint of the business is, and we turn the wheel.
Fascinating. And so do you come up against some of the constraints that maybe the CEO doesn't want to let go of the reins on a CFO position, and like, what's your process for making them feel warm and fuzzy to understand that by letting go of that constraint, they're pulling such a big lever that they can focus their time other places to really scale that revenue?
That's where it takes time. That is traditionally a trust problem. So it's really a matter of, one, financial education, but also when you have a financial dashboard that you can put in front of a business owner and you just tell them like, hey, watch this every week on a Friday. If you have questions, let me know. Watch this. It's going to be updated every week. Keep an eye on it. And then they can feel like they've got that control because they can see what's happening, as well as making sure that they've got access to the team to ask questions. So, hey, our profitability dipped. Why? They should be able to call their CFO and they should be able to explain what is going on. But traditionally, it takes about 6 months to 12 months for the business owner to really start to release that part of the business to us. And that's really something that takes a bit of time. And it just takes trust, time, energy, and effort to make sure that they know that we understand their business at a level that they do. And then over time, they're just like, oh, they'll call me, Aaron, I need help with this. Like, what are we going to do? Or, hey, I'm growing quicker than I thought. Help. I've got too much cash flow. Whichever way it may be.
Nice problem to have. And in terms of when they would come knocking on your door, I'm guessing there's a threshold at some point when they realize they need a bigger solution.
Yep.
What does that look like, as some of the CEOs that are watching this are probably feeling the pain with their books or maybe their tax strategy? At what point do they say, oh my gosh, I need help, this is a great solution?
If your books are getting closed by the 20th, 25th, and you're trying to make decisions and you're doing it on your bank balance, that's a pretty good sign. Second is if you're feeling like your team's not proactive and they're not in your corner, that's another one that's kind of like, you probably need someone that comes in and does it all and works with you directly. The third one is if you feel like you're paying too much in taxes, you're right. That's another one when they come in. But traditionally, you want someone that's above $1 million working with a CFO. If you're below $1 million, you just need a bookkeeper. But if you're hitting that 1 million mark, that's when you really start to need someone that can do financial strategy and really show you the company in a way that you've not seen it before. Because the companies that bring us in early in their life cycle are way easier because you get the right health, like the financial health all dialed in from the very beginning, and it allows you to grow. If I'm coming in into an $8 to $10 million company, traditionally their accounting and their accounting processes and procedures, I'm just going to pay everything whenever I want. I'm going to let the customer dictate my accounts receivables, or I'm not going to just pull the money from their bank account. I don't know what my KPIs are. The further away from $1 million that you get, the more mess it is and the harder it is to clean up. So the sooner you get someone like myself in, the better, because your chart of account or your bookkeeping needs to be structured a certain way as well so that you have the oversight you need to be able to scale it.
Very, very interesting. So now let's kind of expound on that, if you don't mind going a little bit granular. If you were explaining this to one of our CEOs here that we work with or from our channel, and this is the first time even thinking about a CFO's, at what point, or I should say, what does a fractional CFO do, and how do they transform this growing business? You touched on a little bit, but I'd like to hear some of the other items that kind of go in that bucket, because I know it's a lot.
We control the books. Everything starts there. If the books are wrong, every decision you make from a finance perspective is wrong. Accounting is the language of business, through and through every single time. So it starts with your bookkeeping. The way that you need a CFO to structure your books is you've got your cost of goods sold need to be dialed in correctly. You should have general and administrative costs. You should have sales and marketing costs. And then there should be benchmarks allocated against those. If you're outside of those benchmarks, as a CEO, you should be looking at them and finding a way to get to those benchmarks. If you can't, you've either underpriced your services, you've packaged it incorrectly, or you're inefficient internally. So those are the things that we look at very quickly. We look at our pricing, we look at our packaging, we look at our efficiencies within the organization. If you're trying to scale one full-time employee per $250,000, if you can't do that, work out why. The next question you ask yourself, if we're looking to go that next level, is what is your close rate? Okay, if your close rate is 80%, you're too cheap, which is going to mean that you can't get to one full-time employee per $250,000, which means that you're not going and finding your benchmarks because you can never hit them, because it should be that you're doing 60% margins, 15% into sales and marketing, and 15% into G&A. It is one big math equation through your financial statements. That's the first layer. A CFO then should be, and if you're talking with with a CFO who isn't speaking this way, that's a problem. Start like looking for people that are more of a strategic guide than someone that's just looking to protect the balance sheet. They should be taking ownership of all of the data from the sales and marketing team and consolidating everything all the way from the lead to the net income. So they should have all of the bottlenecks listed out for you in every phase of the business, so you can identify, all right, it's a booking problem, it's a no-show problem, your close rate sucks, your sales team aren't operating the way that they need to because they're not following up. They should be able to take all that data and lay it out for you in a way to identify the bottlenecks and tell you, fix this and your revenue will do this. Fix this and your profit will do this. It is really that simple.
So that's really interesting, because from your definition of a CFO, you handle so much of the business. I mean, you're talking about sales and marketing. You're talking about finding the bottlenecks, which is very true. I will agree with that financial data tells the story. Whether you're willing to look at it or not, that's the issue, right?
That's why the dashboard.
You give them a dashboard, is that right?
That's why we have a dashboard that we give to every client so they can see it and we can point it out to them and they can see whether it's doing better or not. Because the CFO needs to act like the navigator. You, say, as the CEO of your company, if we were to work together at any point, it's really like you would say to me, Aaron, I want to go to 35 million this year. I'd be like, okay. I would take all of your sales and marketing data. I would take all of your financial data. I would model that out over the next 12 months, including who we need to hire, what the salaries would be, giving you a salary cap, just like football. Football is like, if you're talking gridiron, they all have a salary cap. You have a salary cap within your business. We would then put the salary cap on what it needs to be, and then we would model it out. You would then get brought that information and say, can we hit this? Is this doable? If the answer is yes, well, then we do it. If the answer is no, we need to go back to the drawing board, because it's my job as the navigator and you as the captain of the ship to work out how much we need in provisions, how much water, how much food, and then watch out for any icebergs and or risk into the future, and then measure it every single month to make sure we're either on track or off track. It is that simple. A good CFO can do
correct as you go. Yeah, I get that. I got that. You know, what we do here at IRC Partners, a lot of the founders I work with here at the firm are at the stage where they're trying to raise 5 institutional capital, $5 billion all the way up to $2 billion from institutional investors. And they think that it's just about building a better pitch deck. That's what I need. I need a better deck. But what we see over and over is the capital. It flows to companies with actual infrastructures, right exactly in line with what you're talking about. Clean financials, sharp KPIs, the right advisors, especially someone like a fractional CFO who can make a deal fundable, which is a lot of times invaluable, right? If they miss some of these steps on our capital advisory, capital raising side, they're dead in the water. So they got to go back and make sure they set that foundation right. Where do you see this breakdown happen with most of your clients? And what role does a CFO play in making a company actually investor ready?
So I've been in funding on both sides. It's not where I play predominantly, but I've been the CFO that's dragged apart people's decks, understanding where you're getting your data from and doing it in a way that substantiates your position. Because a CFO is going to come in and they're going to stress test your numbers. If you can't stress test your numbers and stand on business, and as my children like to say, speak from the chest about your numbers, it's a wish. If you can't substantiate where they came from, whether it's industry benchmarks, whether it's those types of things, you're just living on a prayer, and an investor is going to see that very, very quickly.
Oh, instantly.
And then they're going to be like, these guys aren't ready. And so that's really the first thing that I would recommend. And it is the most important thing from a pro forma perspective, because I've been through enough of them to come in and be like, how did you get that money? Like, how did you get to that revenue number? And that's the most important number. And then you go and you look at their marketing line and they're getting 4,000% ROI on their marketing dollars. It's like, okay, well, tell me how you're doing that. That's better than I've seen in any company I've worked with. And then they start to pull it apart, and then you get dragged over the coals within that. And I've had an investor do that to me back when I was back in college, because that was one of the projects that we had to do. And he was very, very savvy. And so it doesn't feel great when you're running through those, but always just making sure you've got your substantiation and your documentation of where you got it, because at least then, even if he doesn't believe you, at least you can stand on business and you can show them this is where we got it from, even though it should already be referenced in the deck.
100%. I'm so glad you touched on that, because one of the big challenges we see with clients that come in the house for our side is they have these grandiose numbers. Oh, well, we're our valuation sits at 100 million. Okay, what do you substantiate that on? Well, based on comps. Well, you look at the comps and they're nowhere near. But they're growing at 120% year over year. You're growing at 25%, not a comp. So one of our things we have to deal with all the time is we get these ambitious founders, ambitious CEOs that try and straddle the line and put that CFO hat on to their detriment, we find. And so this is the reason why we're having this call. I want to enlighten my channel that there's a better and easier way to farm out the important stuff that you are not a specialist in. That's kind of one of the reasons you and I had talked in the first place. So I'm just fascinated with your stuff, because I am not a numbers guy. But everyone needs to be a numbers guy with their business if they expect some level of exponential growth year over year. So that's where you come in. So let's talk about the KPIs that would be important to a CEO. They say, okay, I'm going to make the investment to have you come in and audit my business. Come in, let's plug the holes with how we're bleeding out now.
Yep.
What would you say the top 3 KPIs are that, number 1, move the needle the fastest, and number 2, that you see most often that are the quick fixes for them?
Do you want it? Because the reality is most CFOs should be looking at the 5 things before revenue. So if you're looking at it from a sales perspective, we should be looking at booking rate, rebooking rate, and close rate, because you want to make sure that you're maximizing your customer acquisition costs or lowering your customer acquisition costs. So your rebooking rate to do that is very, very important. If we're looking underneath the line, customer acquisition cost to lifetime value, and you've heard that one before, customer acquisition cost to payback period. So that is basically working out how much gross profit you make off every single customer, and then working out what your customer acquisition cost is, and working out how long it takes you to pay back, how long it gives you to that customer acquisition cost. So if it costs you $100 and you make $10 gross profit on every single client, it's going to take you 10 months. You can't scale that. It should be about 3 months is where you can do very, very well, depending upon how much gross profit you make. 30 days is good, but if it takes 3 months, that's fine. If it's 3 to 6, you probably more of an amber light. You probably want to do better and raise your prices. If you're 6 months or more, you will scale that thing into the ground. You will see it start to hockey stick, and you'll wonder why your profits are depressing. That's your reason. Every single time. It's always how quickly the money comes back to you that will hurt the company. And then your lifetime value is really, really important. Making sure that you do it after your gross margins, not just based on your revenue.
You said it really best early in the show, and you basically said the answer lies in the data. Roughly is what you said. And I think that a lot of the founders, the CEOs, the owners of these companies that come to us looking for institutional capital, I think that they gloss over the importance of that simple little strategy, I guess. But it's not really a strategy. It's the foundation, the basis of financial health for your company. You have to know the baseline numbers. If you don't know the baseline numbers, that's where Bennett Financial comes in. Get someone that actually helps so you can get a clear view of this 3-dimensional model that your business is. It's not just you rah trying to make more sales. I think a lot of founders just kind of hammer that hammer when in actuality they just need to slow down, plug the right holes, and then start to scale up. Am I far off on that?
Yeah, I've seen companies blow up to $12 million and then make no profit, where the year before they were highly profitable because they scaled it wrong, because they didn't know their data. They didn't put in the right inputs. So the outputs were depressing profitability. They had to use loans to keep the company afloat. They got into financial distress, did all the things. And then we come in and then we worked out what is the problem. We fixed the core problem. Oh, we magically make $1.2 million the next year with no debt. And so we're able to then, with a ton of profit, like 1.2 million in profits. That's after all the expenses and paying off all the debt. And it's it is that simple, but most biz just confront the numbers. It's not, it sucks. You don't necessarily want to do it, but confront the numbers. If you confront the numbers, at least you can know where to start, because you already know there's a problem. You just don't know what it is. But if you look through your data, you will always find it. It is there. It's looking you at the face, and what you think it might be might just be the top level problem of something that goes 3 layers deep. Because that's how finance works. Everything is interconnected. It's its own ecosystem that ties together, and everything works in sync. If something's out of sync, that's the thing that you got to fix.
I relate that. I'm so glad you brought that up, because I relate that to finding trouble in your electrical system at home. That lamp is not working. Well, maybe the bulb is out. No, the bulb is fine. Now you take a step back. Maybe it's the outlet. Outlet's fine. Okay, well, now let's take a look at the cord itself. So it's a systematic approach, just like an electrician would do, which is so invaluable. So that makes sense. When you come into a business like that, like the one you just kind of talked about, what's usually the first metric that you focus on fixing to stabilize cash flow the fastest?
Close rate. Not many CFOs are going to say that. Close rate.
No.
Why? Because if their close rate is 80%, 70%, whatever it may be, they're too cheap. We know immediately that they're too cheap. And cool, you're bringing in a ton of customers. If you're bringing in a ton of customers and you're too cheap, it means you've got to hire more people. If you've got to hire more people, your costs are going up, and then you've got taxes on top of that. You've got benefits. You've got all the different things. So now we know that our margins suck, which then means that our G&A costs suck as well, because now we've got all these different dues and subscriptions and other expenses. So it kind of flows through from there, and we can find the problem right from that.
And do you ever find that CEOs are resistant? They're fighting you to raise their prices?
Every single time.
They'd rather stay at the commodity level because they feel like they have to compete, right?
Well, it's that, and because they've got so many staff. There's a lot of people out there, and I follow a lot of people online that are in the space that say just go out and raise your prices overnight, and you're going to lose 50% of your business. But most business owners aren't going to do that. It's fear, and I wouldn't do it either. There's no way I'm coming into my business tomorrow and raising my prices, doubling it basically, or whatever it needs to be, and I'm going to lose 50% because I've got mouths to feed, I've got all of these different things. So what we do is we say, all right, we model out, add 10%. They add 10%, we see what happens to their close rate. We just stack it one at a time, and once they get to about that 30 to 40% mark, we're at about the right price, then we tier it. Who are your bottom customers? If I was to say today, what customer do you need to fire? 10 will come to people's mind pretty quickly.
Right.
Raise your prices to the new model. And then who's your mid-tier that are kind of like your ghost customers? Okay, go raise your price on them. After you've done that, you kick those out, you then do the next ones. And then if you've got the good ones that you want to keep, well, maybe you raise your prices, maybe you don't. I'll debate with you on that one. If you want your way on those, cool. But that's how you do it. And then you cycle it slowly, and then the profits will start to come up. But it all starts with that close rate. It is the first indicator to tell you whether you are priced correctly or incorrectly. And then the second one is that revenue per employee. Because if you tie those two together, traditionally, if one is out, the other one is out.
Yeah, that's fascinating, because you wouldn't normally think that would be part of the skill set that a CFO would dabble into. At least I wouldn't. I would, my hallucination over the years was a CFO crunches the numbers, reports on the numbers, and, they're a glorified bookkeeper, so to speak. No offense.
That's how it used to be. That's That's why I started this business as well. And the way that I've done it is because too many CFOs were there they were the no man. They would come in and say, no, we can't afford that. We can't afford that. Fire the sales and marketing team. It's just starting now, this new wave of CFOs who are coming in and taking ownership of all of the data and being able to be that strategic partner for the owners. I was in a webinar about a week and a half ago. They're now just starting to, in Fortune 500 companies, speak to that model.
Interesting.
It's starting that wave, and it's becoming more and more important, because who's the closest to the ball that understands the business just as good as the CEO from a numbers perspective, who interprets the data to feed to the CEO so that he understands what's going on and brings up the financial literacy of the CEO. It's the CFO. So that's where the industry is starting to go. You really need to push if you've got a CFO, you need to be pushing them in that direction to take ownership of all of the data sets so that they can model out how else do you get to revenue if you don't know what your marketing and sales data is. You can't.
No, that's very fascinating, because when you think about CFOs taking ownership of the data, are you seeing that shift mostly in mid-market companies, or is it starting to trickle down into the smaller tier businesses?
I only really see it in like larger organizations right now. I am starting to see some CFOs start to take that, and I've been speaking to this on stage to accountants for years, like for the last 3 years at least, to try and get them moving. And so it is starting to trickle because a lot of people like myself are having these conversations to take ownership. So it is slowly starting to get down to these lower levels, but it's just making sure that, again, this is why we have these types of conversations, so that we can start changing the industries. And it's important that CEOs also have this expectation that the CFO starts to take ownership of the data sets, because they're going to be the one best able to project out where the company is going, not just protect the balance sheet and the cash and then say no to everyone anytime we want to do something risky.
And so when you come into, I don't know, a mid-market type of company, and they're having this conversation with you about fractionalizing a CFO position, does that necessarily replace someone in-house currently? And how do they feel about that? Or do you work in unison with the whomever does the books at the companies currently?
Mid-market, you want to do a little bit differently, okay? The way that you do it is you want to build their existing infrastructure with an accounting team. You should have an AP, you should have an AR if they're doing accounts receivable, and you should have a controller. The CFO then takes all of the information from the controller and all of those, takes all the data sets, takes all of the sales and marketing data from the marketing team and the sales team, works with the controller to put together the forecasts and budgets, and then he is the one that takes it all and strategizes with the business owner or the CEO to project out where the company is going and make sure that we're actually on track, and then deal with any of the accounting functions, because the CEO isn't going to necessarily do it, but then also making sure that we're using the tax planning as a way to get more cash, because a controller isn't necessarily going to do that, making sure the tax returns are done correctly, and then push the company forward. So we become the hub for all of the data with the controller to then push forward.
Right. So they're not threatened by you coming in and creating an SOP for growing the company through your methodology.
Sometimes, if the controller's been entrenched for a really long time and they've been telling the business owner no for a really long time, and then other people come in and it's like, well, no, we don't need to fire the sales and marketing team. We need to get more efficient, and this is the actual metric we need to track to get us where we need to go. And then we scale the company at that point, and then we work with the owner. Then once we get the profitability and cash where it needs to be, the controller is normally like, oh, this is fine.
So interesting. So we kind of span the globe here in the CFO model, but I want to get back to taxes just for a second, because that's a hot topic for companies doing 5 million ARR and above, or in your case, $1 million and above. What are some of the biggest tax mistakes that you see growth stage founders make when they come to you?
I'm going to throw my wife under the bus here, and she knows because I use this all the time. It's like my wife going to pick up a $50 pair of shoes and coming back and has spent $300, but I saved $180. The biggest thing that I see is the business owners aren't using structures that leverage their dollar. They're putting $1 in to get a 30 cents in the dollar deduction. Okay, so to get rid of $1 million worth of taxable income, for a lot of people, you've got to spend $1 million, or you've got to go get into debt that would pay off over time, and then Section 179 it, or use bonus depreciation, or use one of those structures, right? But there are structures out there where you can put that dollar in, get $5, $8, $10 of deduction that are safe. And you can use those so that you spend, to get rid of that that 1 million, you can spend $160,000 and have no taxes, rather than spending $1 million or going into debt and loading that up on your balance sheet and doing these types of things. So it's missing these opportunities and accepting that the CPAs are going to say, go put money in, $1 in to get a 30-cent discount. Start looking and start doing your research.
And what kind of structures are you referring to here? Are those typically insurance-based? Are they trust vehicles or something else entirely?
There are some trust vehicles out there, but the trust vehicles take cash off the table as well. So there's trust structures out there where you can put money to the right, 95% of your income across to a trust structure, and you can live your life out of a trust. It's a really good structure if you're a doctor or someone that is in the public eye, where you're likely going to get highly litigated. It makes a ton of sense because you don't own anything. Perfect structure for those types of people. If you're a $250 to $1 million net income company, you may want to go down down the charitable route. That's another way to do it, where you can put $1 in and get a $5 deduction up to about 60% of your AGI. If you want to go and you want to write out, there's business partnerships or like tiny homes, they're called. You can go out and put $1 in, get $5 of deduction up to the total amount of your AGI. But the way that these are structured is it really depends what you're trying to do. Because if I make you look absolutely rubbish on paper, say you make $1 million, you now have 0 AGI. You struggle to get loans. So it's really dependent upon what does the next 2 years look like for you. Do you want a personal home? Do you want to get into real estate? Do you want to get a loan? Then we kind of structure it depending upon what the outcome is over the next 1, 2, 3 years, because the tax game is played over years, not just in the current year that we're in.
Right. Yeah, and it's structure based, obviously.
Yeah.
With strategy built on top of that year after year, correct?
Yep. And some of these compound, and you may be stuck in them for years. Like the tiny home is going to be a 9-year structure that you're going to be a part of. It free cash flows, and it makes a really good rate of return over time. Others, they don't have a rate of return. It's a charitable play, and you're just putting money into things that have a higher fair market value than what you purchased it for. It really just depends. And like with that, it doesn't reduce your AGI. It's just a charitable deduction, so you can get loans off of that if you want to. It really just depends what your position is.
And for clients planning major capital projects or even acquisition, I guess, how far in advance do you start structuring these strategies to align with their landing goals, so to speak?
If you're a C corporation looking to use the QSBS, you want to do it as soon as possible and make sure that you're not putting any tax planning in the structure that could lead to problems. Because then what's going to happen is the buyer is going to come in and they're not going to want to do a stock sale. So as soon as possible, you need to be working with tax planners that are going to plan over years, not just 1 year. If you're an LLC, an S corporation, those types of things, it doesn't matter from a stock sale or an asset sale perspective. The tax planning should be done early in the year. If you know you've got a 12-month runway, get your accounting team in to do tax planning early, because if you leave it to the last minute, like a month before, all of the strategies, except maybe 1 or 2, are left on the table. Don't wait till the last minute. Do it 12 months in advance. Slowly do it. Make sure that they're part of the approach and you know what's happening so that they can get the gates, like you to jump over the gates as you get closer to the target.
So ideally, you're mapping out the tax strategy at the start of the fiscal year and adjusting quarterly as forecasts evolve. Is that correct?
We don't even need to do that. Once the forecast is there, we should set it and keep it that way. Then we'll do scenario planning based on that, and then we'll adjust as necessary. But we don't necessarily then need to touch the tax plan until we get towards the last quarter. Because if you do tax planning right, taxes become more of a choice. And then you know exactly what you're going to pay out at the end of the year anyway. And then you know how much you have to capitalize into the tax planning structures, because with the IRS, there is no free lunch. You always have to put money in. So we know then where we're going to put our cash. And then I'm in the last week of the year. We're basically calculating the final pieces of a lot of our people's tax planning structure for the ones that are using the larger structures. And they're just funding right now. We already know what the last 15 days of the month are going to do. And now it's just putting the money into the structure.
Right,
and
take the money off the table and put it to work.
We had one guy, we brought his net income down, we brought his taxes down to 80 grand from, he was about $850,000. He had to put a little bit in, so it was about $300,000, but we saved him $500,000. I basically told him to do a distribution. Put money into the structure, take that $500,000 and go take it off the table. Go put it into an investment account. So he just did an $800,000 withdrawal, a distribution, paid into the structure, money into his back pocket, and he's going to put it into his investment manager's loving me because now he's got some good money to work with.
This wraps it up in a bow really nicely, and it ties back to how we work with clients as well. When you hire the right advisor that sees the things that your typical CEO cannot see because it's just out of their scope of purview, this is when big things can happen for you CEOs. I'm talking to you. So how do people get in touch with you, Aaron? What's your website?
It's bennettfinancials.com. We actually do, and we're rolling it out as of 1/1. We're actually doing a free tax plan for people to kind of change the industry, because a lot of CPAs are charging for these. So we're able to put one together for people, but we're also doing a full analysis of the business business for free to find the constraints of the business and be able to kind of push the company forward. And we're doing that all for free. If people work with us, great. If not,
Wow.
they can walk away with it, and they can find and be like, all right, this is the thing that I need to fix for the next 12 months.
And you'll be able to identify quickly, as long as their books are not a total mess, where the constraint is and what you can remove to allow that spigot to flow.
Yeah. And they'll have the tax planning side that they should be able to implement on themselves or by themselves without us if they so choose, because more cash means they're able to grow the company quicker, and they'll probably come back and use us in the future anyway.
Love it. Are you a social media guy? Are you on YouTube at all? Where do you...
Not on YouTube yet. More LinkedIn right now, and Instagram is where we're doing a lot of things. I'm starting the YouTube side of things. I'm still learning how YouTube operates. I'm getting used to it.
Okay. Well, how do they find you on socials?
It's just Aaron Bennett, CFO.
Yeah.
That's it. And on Instagram, and I give away all of the information for free. So they can find me on Instagram. Feel free to add me there. And I'm giving like bite-sized pieces of how to do everything that you need to find under the hood, and really just giving away all of the pieces of the pie because it's the easiest way to do it.
Yeah, I mean, if you can get them a quick win right from the get-go, they'll be like, what else am I not seeing here? Right?
Yep, that's the easiest way to do it.
Perfect. Well, I'll give you a follow and share your content with the teams that we raise for, because they all need a fractional CFO. I mean, it's almost non-negotiable, because when we see decks, when we see data rooms and financials, 9 times out of 10, it's a mess. It is a mess.
Yep.
We got to go in and help clean that up, and it's now we're fighting with them over like, where did you get these numbers? How did you come at that? Like, are these audited? Well, it's like, well, what are we doing here? If we're going to be half-assed to the investor base looking for 50 million, you're not going to get past call number 1. So we need to clean that up on the front end. So I'm really happy to have this chat with you, Aaron. Really great to meet you, that mastermind we were part of, and I'm definitely going to be referring you to our clients that would benefit from you, which I think is going to be probably all of us.
Yeah, I find it fun. This is actually fun for me. I do it all day just because I like to play in spreadsheets and like get those aha moments for clients.
Well, I certainly appreciate you. Aaron Bennett from Bennett Financials, fractional CFO, doing big things with CEOs who are ready to release the reins. I love it. Thank you, Aaron. Thank you for your time today. We appreciate it.
Thanks, Sam. Appreciate it.